Yo, what's happening? It is Wednesday, April 19th. I know I didn't get anything on Tuesday because typically I do. My boy Drew is out for vacation. He's entitled to take them, right? And we need him to take them so that he's rested, ready to get at it when he gets back. So he's out Monday and Tuesday. He's back. So I'm getting you on here on Wednesday, and I'll be back on for Friday again. Yes, it should be. I'm traveling that day, but I should be able to get one knocked out. But what I'm going to talk a little about today is I believe we're at, like I've been saying, at the end of the good rates. With like I talked about what Charlie Munger has said, talking about what Buffett has said, and others that I look to, saying that this could be the beginning of 40 years of increasing interest rates, or at least starting last year. There's still a lot of argument out there that the rates are going to go down. So I've got something I want to show you guys. I believe we're definitely there. But before we get there, we've had a little bit of negative stuff happening in the market today. I'll bring up the charts here in a little bit. We got one of the Fed members of the Fed, Bullard. This guy's screaming hike the rates another 75 basis points. We just went up 25. I don't see that anybody's going to try and hike more, but he's saying that jobs are good and all this stuff is good. And we need to keep pushing to bring inflation down. Jobs are not that damn good. We talked about that before. All the hours being cut, right? And that the jobs that have been replaced, some of the large, significant number of those were government jobs. That's not stimulating an economy. When we're having people where they're shrinking in hours and just trying to maintain a staff, but they're not working full time or a full 40 hours, you can see that that's really affecting a lot more. They're going off of bullshit data, in my opinion. So I think, on that note, I don't know that that's going to make anything but noise. I don't see the Fed doing that, hiking it that much. That'd be a significant dent. But the market doesn't worry about that. Of course, they're going to worry about that. What that can do to their money. When I'm talking about the market, anybody who's investing capital into anything wants to get a return. And if the cost of something is higher than what they can sell it for, they're not going to get a return. So that's basically what we're doing. We're going to bonds, and I'll just show you here. We'll go back into the bond charts, and this one I find very, very interesting. What I'm looking at here, and this is a longer stretch on this particular chart. So that's why it's all shrunk down. Every single one of those candlesticks, you're not seeing them as well as you would before because I'm pushing this back a bigger window. So what we're looking at here is from about 2011 to 2023. And what I'm showing here is the current resistance lines that we are basically up against. These are trade lines where the traders will come in and trade, probably, and technicals would have them sell off at this point because the value of the particular security doesn't seem like it would give them what they're looking for, which is return on their investment. And when you're putting money into these pools of money into these bonds, you're locking your money up when it gets borrowed and they're getting a return in the form of interest paid back by whoever borrowed the money. So it's a long-term instrument. Some people get in and out of it, sell it to others. There's just a lot to the daily trade on it. But what I wanted to point out here now, and I could be in the wrong coupon for this. There could be some people that are arguing, but I think we're in the right coupon for it to be able to show this. So what we have here, we've got the current line that is our ceiling of resistance. We have our current support I'm showing here. And then you can barely see where I have right now is this green dotted line. Sorry, you can't really see it. This is our current price on this particular coupon itself. So that's where we're currently trading at. That's where currently the value of it is. That's what is going to dictate our interest rates. Now, if it goes up, our price will get a little bit better. If it goes down, our price gets a little bit worse. We have support here to help us. I drew this yellow, and I also do this green line show the lowest that we've been, period, right? The worst our interest rates have been, the worst that we traded to and then came back from. But I'm showing you this yellow line. This yellow line is the important one. That is at 102.49. It's a price, just kind of market. We're right now at 100.13 is our current value, 102.49. So you can see it's 236 basis points higher is where I drew this line. Why did I draw this? I drew that because if you go all the way over here to 2008, this is where we are right here. This starts at May 22nd, 2008. You go here. This is January 2009, right here, January 1st, 2009. That's where the Fed jumped in. And the Fed started the quantitative easing. All this money, all this value up here, all this huge amount of capital that's in here, bring our rates really low, all driven from the Fed. And then when they said they're getting out, they're going to do the quantitative tightening, they started that back here. It didn't work out so well. They jumped back in really hard, especially right here during COVID. Then they kept pouring in until we get into, the end of 2021, first part of 2022, and they're like, we're backing out. We're not putting as much in. We're not reinvesting into that. We're going to get more off our balance sheet. And look, it fell off a freaking cliff. Well, people are saying our interest rates should go down over the next year. We should see 5%. We're at 6.7 is the last I looked. It could be off, but about 6.7 according to bank rate for just your average loan that people are getting for an average homeowner. That's not investors. And they're thinking it's going to get better. Where's the money coming from? If everything above this line since 2009, January 1st, 2009, was all because of the Fed's contribution, that public capital, the money being created out of thin air, and it was below this, well below this back before it, because interest rates were a lot higher than were back in 2007, 2006. Where's it coming from? I don't know. Now, it could be we get back up in this range somewhere, but for right now, I'm not seeing anything. I mean, my charts don't go far back enough, but I have looked at other things, and we were definitely higher. So that's just where I'm looking at here. I find it fascinating that people are still saying that's going to happen when we see so much here that was done by the Fed. And I'm going to zoom in. Let's look at today's trades to just show where we're at, because I've been talking about this 200-day moving average, this blue line here, pretty consistently, and we get it zoomed in here real good for you. So this blue line here, that 200-day moving average, things are just not getting above it. We're getting beat down below it every single time. Look at where we're at. We're well below it now. We're below every moving average out there, where we just have this support right there to help us out. We got to have some really, really negative economic news to push us back up out of into above these trend lines. And as you see, every time we get above them, we get slammed back down. We get above them, we get down, get above them, getting back down. So we could come right back up and get up in there. Watch when I'm putting these out, guys, because that's what I'm going to recommend. We're going to be locking right now. We got a broad trading range to lock in. I don't know how far it's going to go. It could push a lot further down, and it's hard to say. I'm just saying lock when you can and get your head pointed forward and don't look back and don't worry about it. That's going to be the best thing. Anybody's telling you that we're going to get interest rates going down, I don't know where they're coming up with that, because looking at this, everything that would put us higher in a better position for rates to go lower than where they are now, to go down into the fives, we'd have to really jump this up and have to put a lot of capital and go above that yellow line I showed you. And I personally don't see it happening. I could be wrong, but I don't personally see that happening. So I want to get you that data, know about that. People start talking about wait, and you can get this arm and refinance later. Jerking your chain. They really are. And these arm salesmen are jerking you off. Just don't let them do that. Appreciate you. I'll get you some more data on Friday.